Hi, I'm Justine and today we have Brandon Gilbert with us to give us a little bit of information about our tax planning for this year. So Brandon Gilbert is a partner at MNP, and he is the Regional Professional Lead for Southwestern Ontario. I hope I got that right, Brandon.
You got it dead on.
Awesome. So we're really fortunate to have Brandon here because he is one of those super smart tax minds that I tap into all the time, both for my clients and myself personally, because he's always got some really good ideas and a really great way of explaining these things. So today I wanted to address some of the tax planning opportunities or tax planning themes that both him and myself get a lot of questions on when we're doing planning with our clients, particularly our more high net worth or high income earning clients. So Brandon, you and I have chatted a little bit leading up to this and identified some of the major topics that you in particular are hearing from, and I've certainly heard the same things. Back in 2019, maybe it was 2018, there were some major changes to professional corporations that were enacted by the federal government. And these led to various tax changes in how those corporations were going to work, tax on split income and so on. But one of the big things that was changed was tax on passive income. And I feel like there's some misunderstanding around this and also some maybe unnecessary planning around what this tax on passive income is. So I wanted to start there with you. Perhaps you can just address a little bit of what it is and what the implications of it are and some of the planning around it.
Absolutely. I mean, because I'm the regional professionals leader for Southwestern Ontario, I deal with a lot of physicians and dentists as clients. So a lot of my comments, a lot of my thought process surround those type of professionals. But this same concept applies to other small business owners, other medium-sized businesses that have investments and have that type of income being earned. And a lot of, I'm going to say the comments I have has to do with some of the misinformation, as Justine said, in the investment world. Now, as a small little background, what the tax on passive investment income rules are is that if you have a corporation where you get that small business deduction limit of $500,000, where you're paying corporate tax at about 12.2% in Ontario, the passive investment income rules say if you earn more than $50,000 of investment income, you start to grind away that $500,000 limit and you end up paying a little bit more corporate tax on your active income. Now, when you reach $150,000 of passive income, that small business deduction limit is now zero and you pay a higher rate of tax on all of your active income. So active income is what you're doing to earn practice income, for example, with the world of physicians and dentists. Now, one of the things that we've had a lot of comments from clients and investment advisors over the year is I'm limiting my investment income to $50,000 so I don't get hit with this high amount of tax. And a lot of clients I go back to and say, why? Why are you making an investment decision and potentially limiting the amount of investment income you're earning because of a tax reason, where even though you may pay a higher rate of corporate tax, you're still better off by having the extra investment income, and that extra investment income is way more than the tax that you'll pay. So you're not losing anything out by going above that $50,000. The other thing comes back from when the rules were first enacted, the Ontario government at the time said that they were going to mirror the federal rules. And the top tax rate for corporations in Ontario is 26.5% right now. Well, when the new Conservative government came in I think it was 2018, they decided not to mirror the federal rules. So Ontario is this really anomalous province with respect to the TOPI rules. In Ontario, instead of being 26.5% on that income with the clawback, it's actually 18.2%. And a really weird thing happens where when you take that money out of the corporation where you paid only 18.2% tax, you get this special dividend treatment called eligible dividends personally, where you pay a much lower personal tax rate. So the really bizarre thing is, by the time you flow the income through to you as an individual, you actually save tax overall by triggering into these tax on passive investment income rules. but it's a timing problem, because you pay the extra tax now at the corporation level, and then you pay less tax later on when you're an individual and take out a dividend, and you don't remember the fact that you're still paying less tax total. So a lot of cases, talking to a tax professional or an accountant who's familiar with the rules will help to alleviate a lot of the concerns that you have with the total taxation and remind you of the fact it's not so bad. But learn the lesson out of this: don't let the tax tail wag the investment dog. Make the investment decisions first, and the tax rules will just follow.
It's funny you say that, Brandon. As you were speaking, I've heard you say that phrase many times, amongst other people, and I can never remember what it is. Is it the tax tail? Is it the investment tail? And I was thinking, I wish I could get that right, because that's exactly what I would have said to you at that time.
Well, now it's on video.
Now I just have to check my recording. Exactly. So with that, Brandon, you made a really good point there about how you know, when you do trigger that higher level of tax, first of all, you said it was about 26.2 or 26.5%.
Yep.
And you know, one thing I always tell my clients is 26.5% is still better than 53.5%. So, I mean, the corporation still makes sense, even if you hit that passive income rule. The second thing that I always find when we're having these conversations is that people want to implement solutions to avoid it that don't necessarily make sense for them. So for example, IPPs became very, very popular again when this came in. IPPs can be fantastic for the right people at the right time, but it's not something that everyone should set up just to avoid this passive income tax. And the same goes for, and you're going to be shocked when I say it, but permanent life insurance. Obviously, I love permanent life insurance. I really do, but there is a time and a place for it. And just because you're going to run into passive income in your corporation does not mean you should buy a big permanent life insurance policy to prevent it. If it's right for other reasons, then yes, but that can be one of the added benefits of it. But
And
it's not the reason to buy it.
I'd say it's one of the happy problems you have with high income, high net worth, high saving individuals, is eventually that limit of $50,000 limit, so to speak, and the 150,000 aren't actually going to matter, because the clients who really save their money, the amount of capital that they're accumulating within their corporations, they're blowing way past 3, 4, 5, 6, $10 million of income over their careers that they're saving within their corporation. If you had $4 million sitting in an investment account and you are earning 3% as an investment return, which is not amazing, but okay, you have $120,000 a year of passive income just being generated from normal distributions. So all of a sudden your small business limit goes down to 150 grand and you're caught by the rules. Are you going to suddenly say, I don't want to save $4 million in my corporation? No.
Probably not. Yeah, $4 million is better than saving the tax.
Yes. Yeah, pretty much anything is better than zero. So I'd rather have the $4 million and pay that extra little bit of tax, because you're still better off if your investments are generating. If you have the 4 million generating a 6% return on average, you're at $240,000. You're going to be well above that. And to be quite honest, I would just be ecstatic to have $240,000 of income being earned without me having to lift a finger. And that's all the hard work that our clients and us put into what we do to be able to save that amount of capital, which I'm sure we'll get into a retirement discussion about that as well.
Well, I was just going to say, the other little nugget that we'll plant here and maybe talk about in the retirement discussion is something that you mentioned about the type of dividend you can draw at the end of the day. And so, yes, you pay more tax now, but once you eventually draw dividends later, you pay less tax on that dividend. And so in the accumulation period, paying more tax is not always what you want, but in the decumulation period, having more tax efficient vehicles to draw off of can help with a lot of different areas of planning. And so sometimes it is a bit of short-term pain for long-term gain. A bit of an inevitability, like, you know, you're earning more than $50,000 of passive investment income. That's not the worst scenario to be in. And you know, the outcome is going to balance out at the end. So yeah, you're right. You know, there's a lot of planning that happens that is sometimes unnecessary planning that people should be a little bit cognizant of as they progress forward with that concern.
Yeah, don't get me wrong, tax planning is important
Yes.
because that's a lot of what I do with my day, and that's a lot of the value that we try to bring to our clients, is bringing those ideas to look at not just what's happening today, but what's going to happen in 5, 10, 15 years as they approach retirement or go into that big asset accumulation or decumulation phase. But it's also having that other side to say it's not just taxes that matter, it's all the other planning. It's what do you want to spend in your retirement? So one of the other topics that comes up a lot with clients is old age security. And that a lot of them have that focus where they go, I want to get that old age security. I want to limit my income so I don't have any of the clawback. And the honest answer to a lot of high net worth, high income, high saving individuals is you're not going to go at old age security, because I see a couple of things potentially happening in between there. One is old age security has that clawback limit. And this year in 2021, it's roughly $80,000. So any income you earn above the $80,000, if you're collecting old age security, you lose 15% of the OAS that you get. If you're spending $200,000 a year of cash and it's just you and your spouse, there is no way that you can keep your income below that $80,000 unless you had money that has been stashed away on the side in non-registered investments or tax-free savings accounts from previous years that you can draw on to get that money out. So in a lot of cases, I say to clients, don't bet on getting OAS, don't focus on getting OAS. When you get to the point of claim, take it. And if you end up with some of the years where you happen to have kept some of it, great. But otherwise, don't expect it, because OAS is really designed to support individuals who don't have the same amount of wealth, net income, and abilities that you would have. So
Yeah.
OAS, don't expect it. The other thing that I would expect is I have a feeling as they keep raising this OAS level, they may end up changing the OAS system because it's an unfunded pension. With Canada Pension Plan, you contribute, your employer matches, the government protects it, and then you get it back. With OAS, it comes out of your general tax pool. It comes out of general revenues of the government. I can see at some point them changing the system to be really tailored towards those low income individuals and take that clawback limit, maybe not from 80,000, put it to 40 or some lower number, but then change the taxation of the system so that it becomes a non-taxable type of income to really help and support those that have trouble paying their rent, as opposed to buying a second property.
Yes. Yeah, really, really good point. Let's dive into this a little bit more, because one of the topics we want to talk about today, and this kind of segues nicely, is that retirement income planning, if you want to call it that, where there's some planning that can be done leading up to retirement to help your tax bracket and so on, and to try to gain your OAS. But more likely, you're doing tax planning to, maybe I'll let you take it from here, but to gain some income splitting and so on. And people will come up with a lot of different scenarios on how to reduce their taxable income in your retirement using various vehicles that, again, can sometimes not make much sense at this stage. So why don't we dive into that a little bit?
Yeah, so I'd say for the retirement planning, something that came into place, which Justine had mentioned earlier, was those big taxable changes. One of them was the tax on passive investment income. The other was tax on split income. So that tax on split income rule is where we used to have a lot of the corporations with family member shareholders where the family members didn't really do anything. But if you had them as the properly structured shareholders, you could take the profits of that overall corporation and sprinkle them down amongst the family members. When the tax on split income rules came into place, it suddenly limited a lot of people's ability to take that income, split it amongst all your family members. And in many cases, it can only go to one or two particular individuals. Well, one of the things that came about from that is in retirement planning, first thing, retirement planning was affected because the amount of money people were accumulating was decreasing because they were paying more tax when they were extracting the money out of the corporation. And if you have high income, high spending needs, you're going to be pushed up above that 53.5% tax bracket, which in Ontario starts at 220 grand. And just to give you an idea, if you had $220,000 of income the after-tax cash on that is about $136,000, which is roughly, oh, my mind just lost it, about $11,000, $11,500 a month of spending. You can imagine if you have a big mortgage where it's $5,000 a month, you have a car payment, you have expenses, you're going to be burning through that $11,500 a month fairly quickly. And the only way to get extra cash, take out extra dollars, and you're paying 53.5 cents on salary, 48 cents on any dividend. So it's a really high rate. So what we were seeing is we used to get about $25,000 by income splitting with a spouse of actual cash tax savings, which when you back that up into the corporation world meant that the corporation got to retain $40,000-ish of cash for long-term spending. Over a 10, 20-year period, that's $400,000, $800,000 plus growth. Mm-hmm. So imagine $1 million being taken from your retirement with a quick little change to the Tax Act. Mm-hmm. So that's the first thing we saw, is that the retirement assets being built up was a little bit slower. The other thing that we saw is before a lot of corporations, in particular professional corporations, came about, we had what were known as spousal RSPs. So a lot of the high income individuals were using their RSP room to contribute to their spouse's RSP. And then when in retirement, the spouse would withdraw the money to themselves and pay tax at their tax rate instead of withdrawing it to the physician or the dentist or the owner at their higher tax rate because they had all the other net worth and the other value. Mm-hmm. With this change to tax on split income, we're seeing a lot more of the shift, and we're even recommending to a lot of our clients to take that RSP limit of the high income spouse and contribute it over to the low income spouse, stash it in there just in case they change the rules again. Mm-hmm. So right now we're allowed to have pension splitting, where you can take a pension and split it between two individuals. We have with corporations where when the primary shareholder turns 65, then they can turn on dividends to their spouse again. But for example, I'm in my late 30s. That is 25 years, 26 years away for me. Do I bet there's going to be a tax change in there? Yes, I do. So it's that hedge to say, if I put the money over to my spouse's hands, it's their RSP. It's been in a plan that's been in place for many, many years. When they retire, when we retire, they can withdraw it back out. They get the income, saves a little bit of tax in the long run. Mm-hmm. The other big thing with retirement is to realize that, and it's talking with a life insurance agent, of course, everyone has to die eventually. And it's one of the big questions I get asked is, well, what happens when I die and my spouse dies? What happens to my corporation? What happens to my assets, my wealth, all those other things? And unfortunately, there's very few methods right now where you can try to reduce your tax bill. It's not avoiding it, it's just reducing it. And one of the things I say to clients is, whatever you've accumulated within the corporation, you may have to, or your estate may have to pay 50% tax on that money that's been built up, because when the last person passes away of a husband and wife, there's no mechanism to be able to take that and pass it down to the kids effectively or efficiently. There are some more advanced plannings, which I'm not going to get into now, but those plans could be taken away from us in the next couple of years anyways, because the government is always watching. And when something becomes popular, the government usually steps in, legislates something to stop it so that they can keep trying to get the tax revenue coming in. Mm-hmm. Some people may not think it's fair, but it's the way the system is currently structured.
Yeah, one of the true certainties in life are both debt and taxes. I say the same thing. It's you can't avoid tax. You can defer it, or you can possibly reduce it in some circumstances. But one of the brilliant minds in our industry always says, and I take it from him all the time, and I'll give him full credit for it because it's definitely his. But he says that when you die, there's 3 places that your money can go to, and you get to choose 2 of them. There's your children, charity, and the CRA. And so who do you want to have as the 2 primary inheritors of your estate? And then that's where the complex planning that I'm sure we're both thinking of in this kind of fits in. Life insurance being a big one, but there's a lot of other little keys in there as well. So yeah, and so with that, the planning that we often do, and you've seen a lot of these plans that we produce, Brandon, for our mutual clients, these plans, you know, they take a look at the retirement income and how it's going and so on, but also what is that estate going to look like and how much of that estate is going to be shoveled off into taxes, and then how can we do some of the planning around that. But in there too, the last thing that I want to jump into is in this same kind of notion of doing this tax planning now and in retirement, lots of questions, and I think we both get them on TFSAs, especially for incorporated professionals, you know, because it is tax-free money when you withdraw it from the TFSA. And so the argument is that, you know, if you do have some big expenditure, then you've kind of sprinkled out income in other years that you can then tap into when you need it. And in retirement, it can be this tax-free source of income that, you know, if you do want to take that big, like master $25,000 vacation or something that you dreamt up your whole life, that you don't screw up your whole tax plan, or maybe it will help you prevent OAS clawback and all that glorious tax planning stuff. So thoughts on TFSAs?
I'm going to say I have a love-hate relationship with TFSAs. So I love TFSAs in the sense that while you have money in them and they're being used properly, they are truly tax-free, they grow tax-free, they can become this lovely vehicle. The hate relationship I have with them is that it's quite challenging to actually fund and contribute the money into the TFSA. If you have windfalls, if you have extra money sitting around, if you have a lottery win, if you have an inheritance, a perfect place to put the money is a tax-free savings account, because you as an individual didn't have to pay extra tax to be able to put the money into the TFSA. So the hate relationship is, and it's nothing against investment advisors because they're doing their job, but a lot of times the goals of the investment advisors don't always line up with, in this case, the tax tail. Now I'm regretting saying that earlier a little bit, but
Yeah.
I'll explain a little bit of why. So let's imagine that we have a client and over the years they've accumulated $50,000 of tax-free savings account room. Let's also assume that they are a higher spender and they have their income at that magical $220,000 limit. So we would know that any extra cash that they would pull out of the corporation would be taxed at 48% on a dividend, 53.5% on salary. With the client coming to us and saying, I want to put $50,000 in my TFSA, the first thing I say to them is, well, that's great, but if you want to take the money out of the corporation, you're going to need to use about $96,000 of corporate cash, extract that out of the corporation investments, pay $46,000 to Canada Revenue Agency, and then you get to put $50,000 in your TFSA. And they go, well, that's a lot of tax. I say, yes, but it's because you're at the top tax rate. And in order to get the money out of this spot, to get it into this spot, you have to pay tax. So then the next thing they say is, well, my investment advisor has said that the TFSA will grow and build and that it is a better investment to put it into there, not have any tax paid on it, and it will be a bigger dollar value than with the money if it was left within the corporation. And my counter to that is, if you have the same investment strategy within your corporation as you have within the TFSA, and let's assume that rate of return was 5%. In your TFSA, year number one, you would accumulate $2,500 of investment income, and you get to keep all $2,500 of the investment income on that $50,000. Seems easy. Within the corporation, that same $96,000 that you wouldn't have had to pay tax on if you didn't withdraw it, you would have $4,800 of investment income. But then we have a tax drag. And let's assume that tax drag is interest income, which ultimately is about 20% as a tax rate. So that 20% tax rate, $960, let's call it 1,000. The corporation gets to keep $3,800. So quick math tells me 96,000 plus 3,800 we get to keep, that's $100,000. And the $3,800 is a bigger number than 2,500. Mm-hmm. Plus, I still have the original $46,000 I didn't have to kick over to CRA. Mm-hmm. So I've done the math, shockingly. But when doing the math, I've compared different types of investment income. I've compared eligible, non-eligible dividends. I've compared capital gains. I've compared interest. I've compared foreign income, all of them in there. And if you have the same expected investment return, the TFSA will never catch the after-tax cash that you could pull out of the corporation at the top tax rate by not paying the tax today. If you took home run type of approaches and you were chasing 20% your TFSA and your corporation was earning 4%, absolutely the TFSA is going to win every single time. But you also have the risk of losing 20% within your TFSA with that type of a strategy. So I usually say, if you have the same investment strategy, the TFSA can't win. But if you have this extra cash sitting aside, if you have an inheritance, you have a windfall, if you have some other way to get the money in a tax advantaged way, put it in your TFSA every single day of the week. Makes complete sense.
Some people, like especially those who are, medium spenders, and so perhaps they're not in the 53% tax bracket, they're more in the 40-ish% tax bracket. Some of those guys, I find when they pay their mortgage off or something, they're like, well, I can either reduce my taxes down by not taking as much out of my corporation, or I can just leave that income the same and now take the excess and start stuffing money in the TFSA. So I do see both, and I think it depends on the person, but I otherwise agree with you.
Exactly. And one of those tax strategies within the corporation, it's a concept called a capital dividend.
Mm-hmm.
And a capital dividend, if you have the ability to take it out of the corporation, is a tax-free dividend. That is an amazing way to fill up a tax-free savings account because you didn't pay any personal tax on that.
Mm-hmm.
But you need a bunch of capital gains that are within the corporation in the first place. You have to trigger those gains. You have to pay the tax on them, which may trigger tax on passive investment income to happen the following year to get that capital dividend account. So it's a big circle of tax planning that comes in, which is why it's always important to have a conversation with your advisors and to make sure that what they're telling you makes sense. They're telling you it in plain language and that you understand what's happening, because ultimately we can't enact any strategies unless the client has an understanding and they accept and that they authorize us to proceed with those strategies. But what you do today may affect tomorrow, and having that plan in place is good. The one last thing I wanted to mention, because you mentioned the retirement planning, it's not just a one-time retirement plan. It's you do it this year. You may not look at it next year, but in 2 years or 3 years, you redo the plan, you check it again, you compare it to see how you're doing, and that may change some of the direction on what you're doing with the planning. And shockingly, if we did a plan 3 years ago, tax on split income, tax on passive investment income came into place. All those plans that are 3 years old or older are no longer applicable.
And what you're saying is just, so near and dear to my heart, because we say that all the time to our clients. And that's actually one of the reasons that we kind of rebranded ourselves into Zavitz Insurance and Wealth. And I think, some of what you've been alluding to today, Brandon, is you could create the tax plan, and then the client may or may not go see some other advisor, whether it's the investment advisor, the insurance advisor, the banker, whoever, and their recommendations could contradict the tax plan. And now the client's in the middle trying to understand all of this. And so some of the planning that we try to do is to take all of these pieces and bring them together to say, if this is your goal out here, here's how we're going to take all these pieces and try to move them forward towards that goal. And then we will work with all these other advisors. And, we'll have a brilliant mind like yours who might say, have you ever thought of this or that? And we'll tweak the plan at that point in time, or the investment advisor might say, we want to do this or that. And we'll slowly come to this path forward that we will then revisit every couple of years, because not only could life change, tax rules can change, investment returns, assumptions, everything can change. What's important to you might change. You might have a health problem, whatever. So that's why we revisit. So, it's near and dear to my heart. It's, I think an important way forward. I think like our clients need to understand that. And
we can see that in this last year because of the effects of COVID and the stock market decline that happened in February, March. If you were doing your planning in April compared with today, it'd be night and day on the investment returns and the expectations that you would have put in place.
Absolutely.
There's no such thing as a perfect plan. There never will be. There can't be, because of this little thing called chaos theory, which will always cause something to shift or to do something different that'll happen. Exactly. So perfect plan is fine, but you at least have to have the plan so that you have a goal, you have a direction to go into. And I say that to a lot of clients where they go, oh, let's do it next year. Earlier this week, I had a conversation with clients, and that next year has been the last 10 years. Next year, next year, next year, next year. And then finally, they hit the point where they went, we really need help. And they came to that realization that without setting those goals, without having the plan in place, they didn't actually have a goal to get to.
And you know what, at that point in time too, it can cost a lot more money because there's a lot more time that goes into developing it. It's 10 years to sift through. And we say the same thing all the time. We can create a plan really quickly and really easily for you when you just come out of residency or you're a couple of years into practice, and you need to know what to do with your income, versus when you're 58 years old and you're like, okay, I want to retire in 7 years. That takes a lot more work and a lot more planning to get all the pieces of your life together and try to figure it out. And obviously with insurance, if you hold off too long and then you actually need it, that's when you can't get it. So that's also an expensive mistake. So
yeah, and we're very cognizant when we're talking with clients to mention the insurance piece, because I personally am a big believer of insurance. I'm lucky enough to have Zavitz Insurance as my own advisor. So life insurance, disability insurance, absolutely critical when you're starting out to build it up, because you never know what's going to happen. You never know what's going to happen in your career, in your lifestyle, in your medical ability, or what's going to happen if you walk across the street. You just don't know. So, and then using those resources and making sure, Justine mentioned a little bit earlier, permanent life insurance. Great product for the right people. And permanent insurance that's sold primarily as a tax avoidance strategy is not the reason why you need permanent life insurance.
I always say, if people tell you that it's a retirement planning tool, that's when you know you need to walk away. It is life insurance first and foremost. Can it be used if you need it? Absolutely.
Yep.
But let's not plan to need it.
I call it the retirement account of last resort. So if everything else is gone and you have this permanent life insurance policy, that's the time to use it for your retirement living. But otherwise, it's a different strategy. It fits for some people, but you have to understand the product.
I think it's a risk tolerance thing too. It's really funny. I look at my mom now, she's at a stage where she takes a little bit more risk sometimes because she's able to. And she says, from a taxation perspective, leveraging is really tax efficient. And so, she's going, I feel like I am going to leverage my life insurance, because I'm like, why not? Because, all the risk that comes with leverage, I'm okay with. And I find that it's a good tax planning vehicle. And so, it's funny because for myself, I'm like, no, I'm not there yet. I'm not okay with leverage because I don't know that I have the fallback plan in place.
And Terry has an advantage because she has a daughter in the industry who understands the product. And I explain this to a lot of clients where I say, if you leverage the life insurance, take a loan on it, and you are gone, is your family going to understand what happened with this life insurance policy, who is owed money back, and more importantly, specifically for tax purposes? Are they going to be able to flow the money properly to not cause a very large tax problem on when that life insurance is paid out?
So true.
And that's the simple thing, is people say, oh yeah, just leverage it, it's easy. No, there's a lot of actual tax issues that come along where I am aware of a lot of tax things, but if we have any of those policies that come through, they're leveraged in MNP, I'm bringing in my tax specialists who deal with life insurance specifically to work with the family and work with the lenders to have it so it doesn't cause a big CRA problem. And that's some of the problems that happen when you're dealing with advisors that are looking for just the sale, so to speak, as opposed to what's right for the client. And always what we try to do, and I know that Justine does this and Terry does this, is do what's right for the client, and the client will always be thankful for that.
What a way to end it, Brandon. I love it. Thank you so much for joining us today. I always love talking with you about this stuff. I also firmly love tax as much as I wouldn't want to be an accountant. So thanks for joining us. Follow us on our socials. We always have stuff like this coming out. We're on Instagram, LinkedIn, Facebook, and I'm going to add Twitter. I think we're on Twitter too. But also check out our website, zavitsinsurance.com. And thanks, Brandon. Appreciate having you with us.
I really appreciate the chat, and thank you for having me.
Talk to you soon.